What if I told you that the way most people invest, the way the experts have been telling you to invest for decades, is quietly working against you, not because they're lying, but because the system they're teaching you was never designed to truly protect your wealth? Today I'm going to show you a portfolio built with just 4 investments, simple, elegant, and powerful enough to grow your money and shield it at the same time. No complicated strategies, no stock picking, no market timing, just 4 investments and a completely different way of thinking about your financial future. Let's get into it. Section 1, the problem with the classic approach. If you've ever asked a financial advisor how to build the perfect portfolio, there's a very good chance you receive the same answer that millions of people get every single day. The classic 60-40 portfolio, 60% in stocks, 40% in bonds. Now on the surface, it sounds balanced. It sounds responsible. But here's the thing I want you to really sit with for a moment. Is it actually protecting you? When experts recommend bonds, they mean things like corporate bonds, mortgage-backed securities, and at the core of it all, US Treasury bonds. They'll tell you it's safe. They'll tell you it generates income. They'll tell you that 40% of your money is risk-free. But here's the truth that doesn't make headlines. Fixed income loses purchasing power during inflation. Think about that. Your safe 40% is sitting there earning maybe 3 to 4% per year. And that's your pre-tax return if it's not in a retirement account. Meanwhile, the real rate of inflation is quietly eating into that money every single year. So that so-called risk-free investment, it's not risk-free at all. It's just a different kind of risk, one that's slow, invisible, and devastating over time. There has to be a better way. The 4 investment portfolio, and there is, what I'm about to share with you is how I would structure a portfolio if I were viewing all of my paper investments as a whole. Your 401ks, your 403bs, your IRAs, your taxable brokerage accounts, everything combined seen as one unified strategy. And for clarity, I'm not including your primary residence, rental properties, physical precious metals, 529 education plans or HSAs here. Those serve different purposes. We're talking purely about your invested financial portfolio. Here it is. 4 investments, 4 allocations, 50% into S&P 500 index funds or ETFs, 10% into international stocks through an index fund or ETF, 20% into gold, and 20% into your opportunity bucket. That's it. 4 lines, 4 decisions, and a framework built to perform in any economic environment. Let me break down exactly why each piece belongs here. Section 3, the foundation S&P 500 50%. The anchor of this entire portfolio is the S&P 500, and for good reason. When you invest in an S&P 500 index fund or ETF, you're not gambling on one company, you're not placing a bet on one industry, you're buying a stake in the 500 most powerful companies in the American economy, companies across technology, healthcare, finance, energy, consumer goods, and more. And here's the beautiful part. The index manages itself. If a company weakens and falls out, it gets removed. If a new company rises and earns its place, it gets added. You're always holding the strongest companies the market has to offer without ever having to lift a finger. This is how you capture long-term growth without guessing, without stress, without spending hours watching stock tickers. 50% here is your engine, your foundation, the force that drives your wealth forward over time. Section 4, the global layer. International stocks, 10%. Most investors never think about this one, and that's exactly why it's important. Putting 100% of your investments into a single country, even a country as powerful as the United States, is still concentration risk. Economies move in cycles, and different countries go through different cycles at different times. By adding 10% in international stocks through a fund that covers both developed markets like Japan, Germany, Canada, and the United Kingdom, And emerging markets like India, Brazil, China, and South Africa, you gain something invaluable. You gain global diversification, currency diversification, and a buffer against over-reliance on any single economy. This isn't about chasing higher returns, it's about building a portfolio that doesn't have a single point of failure. Section 5, the insurance policy, gold, 20%. Now here's where the portfolio becomes truly different, 20% in gold. Most traditional portfolios barely mention gold, and when they do, it's often dismissed or minimized. But I want you to understand what gold actually is in a portfolio like this. Gold is your insurance policy. Think of it this way. Imagine you buy one gold coin and you put it away. 5 years pass, you open the drawer, you still have one gold coin. It didn't multiply, it didn't generate dividends, it didn't go to work for you in the way stocks do. But here's the critical insight. The price of that gold coin will almost certainly be higher because it now requires more dollars to buy it, more devalued dollars, dollars that have been weakened by money printing and inflation. Governments and central banks can print as much currency as they want. They can create trillions of dollars backed by nothing but faith, but they cannot print gold. Gold has been a store of value for thousands of years. When currencies weaken, and historically they always do, gold rises. It's not about growth, it's about protection. It's the part of your portfolio that holds its ground when everything else is shaking. 20% here means that no matter what happens to the dollar, you have a meaningful position that works in your favor. Section 6, the opportunity bucket, 20%, and finally the last 20%. This is what I call your opportunity bucket, and this is where you get to bring your own conviction to the table. This 20% can go towards silver, copper, uranium, oil and energy companies, individual tech stocks, REITs, real estate investment trusts, Bitcoin, other crypto assets, cash reserves, or even a combination of all of these. The point isn't to tell you exactly what to buy. The point is to give you a container for your best ideas and your highest conviction bets. Here's the rule though, and this one matters. Keep your speculation contained to this 20%. There is a very real difference between smart investing and gambling. This structure lets you take calculated risks without putting your entire financial future on the line. You get to participate in high upside opportunities while your other 80% stays grounded, disciplined, and protected. Section 7, the big picture. So what does this entire portfolio actually give you? It gives you growth through your S&P 500 foundation. It gives you protection through gold. It gives you diversification through international exposure and real assets. And it gives you flexibility through your opportunity bucket. But perhaps most importantly of all, it helps you stay invested. Because here's a truth that most people never really internalize. The markets are designed to go up over time, not because of any magical force, but because of the same money printing and inflation that threatens your purchasing power. Asset prices rise because there are more dollars chasing the same assets. Do you think the median home price will ever go back to $50,000 like it was in the 1980s? Of course not. Do you think car prices will ever return to $15,000 the way they were in the 1990s? Never. Then why would stocks, gold, or any other real asset crash and simply stay crashed? They don't. History proves that time and again, the system has ups and downs, but the direction of travel over the long arc of time is up. So why do most people fail to build a strong portfolio even when the strategy itself is this simple? It's not intelligence, it's not access, it's not resources, it's behavior, it's the panic during downturns, the temptation to time the market, the impulse to constantly move things around, buy, sell, react, and in doing so, undo years of patient compounding in a matter of days. The hard part was never the strategy. The hard part is consistency, discipline, and the quiet confidence to hold your position while everyone around you is losing their minds. You don't need complexity to build real wealth. You need a simple structure and the wisdom to stick with it. For investments, a long-term mindset. And time, that's the portfolio, that's the philosophy, and now it's yours.